In this video, we're going to be calculating mortgage payments. Now, there's a couple of ways that you can do this. In this video, we're going to be utilizing what we call a mortgage table or a mortgage factor table. And we're going to be using this table to kind of simplify some of the calculations. But in a later video, I'll walk through how to perform the calculations utilizing a formula that's a little bit more in depth, but is really helpful if you don't have access to some sort of mortgage factor table. So for starters, let's talk through a particular scenario so that we can begin to plug in some information. Now, obviously, when you're trying to calculate your mortgage payments, this is helpful. One, if you're trying to do this for some sort of assignment, but also for your own personal use, if you're trying to figure out what you can expect in terms of a monthly mortgage payment, if you're trying to do a little bit of budgeting and figure out, roughly how much money you have to spend and what type of home you can actually afford. So let's say you want to buy a home and the total price, or let's just say the purchase price of that home is $225,000. Now you plan on putting down a 20% down payment. So what that would mean is that you really aren't going to finance the entire thing, right? You're coming into it with a little bit of cash, which is great because you can avoid paying the costly private mortgage insurance, which can add several $100s onto your monthly payment. So we're going to pay 20% down, which means that we only really need to finance $180,000. Now this is going to be our principal for the mortgage. This is the amount that we are financing, and that'll be $180,000. Now, one thing I want to say is that if you are solving a personal finance problem, oftentimes you're not provided with the purchase price and the down payment. Many times they just provide the principal amount. So just double check and make sure when you're reading the question, you know exactly what the information is being provided to you. Now, the other thing we need to know is what our interest rate is on this mortgage. And so we're going to say that our interest rate, that we're going to abbreviate as I, is 4%. And the term of this mortgage is going to be a 20-year mortgage. Okay. Now, obviously the term can vary. It can vary from something as simple as 15 years to 30 years and variations thereof. You can obviously do 10. Most common that we see obviously are 30 and 15. 15 results in a more expensive monthly payment, but helps you pay off the house much sooner, which is always nice. So now that we have some of the basic information, what we're going to do is we're going to try to figure out our mortgage payment. So to do that, we're first going to look through the mortgage payment formula. In that formula, to calculate our monthly mortgage payment is our mortgage payment factor, which we're going to get just in a moment here, multiplied by what we call our mortgage amount, which is the amount that we're financing, divided by 1,000. And that's it. So there's a couple of pieces of information we need, really one piece of information, that is this mortgage payment factor here. We have the mortgage amount, which is our principal that we're given, and then we have the $1,000 here. So notice this formula does not incorporate the interest rate or the term just yet. We're going to actually bounce over to the mortgage payment factor table, and we're going to use that information here. So what you're looking at in front of you is a mortgage payment factor table. Notice at the top in the first row, you have term kind of amounts. So starting from the left-hand column here, we have 30 years, moving all the way in 5-year increments over to 15 years. And then in the leftmost column, this is our term rate or the interest rate that we have here. And so moving in 0.5% increments from 3 all the way to 8%. So the way that you would use this is you simply have to match up the column and row that match the term as well as the term rate. So moving to the first row, we would try to identify our term, which is 20 years. So that would be the second column from the right. And then we're going to go all the way down until we get to the row that has our 4% term rate. And so really our mortgage payment factor is going to be the 6.06. So if we were to move down with our calculations, we would fill in the mortgage payment factor of 6.06. And then we're going to multiply that by our mortgage amount, which for us is $180,000. And we're going to divide that by 1,000. So really at this point, you don't need a calculator unless you just want to be overly thorough. We know that we're going to carry this 6.06 to the next sequence, and we're going to multiply this by 180. And then taking our 6.06, multiplying that by 180, that is going to give us a mortgage payment amount of $1,090.80. So this would be the monthly payment that we would incur in order to purchase this home at $225,000, assuming we're putting down our 20% down payment, assuming we qualify for a 4% interest rate, and we're carrying the loan out for 20 years. Now, we can, of course, pay more than this, and then that will lower the amount of time that we need to pay off our mortgage, but this would be the requirement. Now, one thing I want to mention too is that this is not an all-inclusive amount if you're purchasing a home. And that's one thing to consider when you're doing these calculations, because there are a couple of other things that we also have to include that are typically associated with our monthly payment, but not always. So one of the things that when you're purchasing a home that you often see is what is called an impound account. Now, many mortgage companies require impound accounts. Some do not. Many mortgage companies, in fact, all that I've seen, will require an impound account if you put less than a certain amount down, maybe 20% or so. And that is just in order to cover a few things that you're going to have to pay anyway. So let's add a few extra elements here to our scenario. And let's add property insurance, or commonly referred to simply as homeowners insurance. And let's add property taxes. Now, this is different for every state in the U.S. I live in California, which tends to have high not only property insurance or homeowners insurance and also property taxes. You might live in a state that has relatively low property taxes. It all just depends, but you can kind of get some information on really what kind of a average rate is for the purpose of your calculations, or make a few calls and try to see roughly what those numbers would be. So for the purpose of this kind of scenario, we're just going to assume that we pay a annual property insurance of $800, and our property taxes are going to be $3,800. So we'll keep it nice and simple there. Now, in order to figure out our total housing payment, right, not just our mortgage itself, but our total payment, assuming we have this impound account, we need to add a couple new elements here. So we're going to calculate our total housing payment, and that is going to be equal to our mortgage, which I'm just going to abbreviate as M, and that we're going to multiply by our property taxes plus our property insurance, and we're going to divide that number by 12 to get it into monthly payments. And one quick note here is there should be a plus sign here. Otherwise, this is going to be way too expensive. So first, we're going to solve for what is going to be in parentheses and then, of course, the brackets. So moving down, our property taxes are $3,800. Our property insurance is $800. And we're going to divide that amount by 12, which will get us $383.33. So now what we have to do is we have to go ahead and move this over, and we're going to add our mortgage payment that we identified as $1,090.80 and add that to that $383.33. So if you add these two numbers together, you're going to get an end result of $1,474 and lastly 13 cents. And I didn't mention this before, but in terms of rounding, it's pretty common to round to the nearest hundredth, because that just makes sense in terms of dollars and cents. But if you are doing some of the calculations ahead of time, don't round until the very, very end result, because it might not seem like a big difference, but it can obviously change the end result. And if you're trying to be 100% accurate, that could affect whether or not you actually get there. So looking at the equation here, calculating our mortgage payment, right? We used the mortgage payment factor table, and then getting our monthly mortgage payment of $1,090.80 here. We then added in our property taxes as well as our property insurance on a monthly basis to derive or get to our monthly or total housing payment on a per month basis here. So this gives us a much more realistic idea of what our housing cost is going to be. I will add, if you have a pay into a homeowners association of some kind, it's always helpful to incorporate those, since those are directly related to housing type costs, and it helps you get a fuller picture of what you're going to be paying each and every month. But going through this exercise can be pretty helpful, because then you can do the math and figure out if that monthly payment works for your budget. Now, I will add, just as an aside, that in some instances, you are not required to bundle your property insurance and property taxes into your monthly mortgage payment. However, you are still responsible for those. So even if you don't have to incorporate those in your monthly payment, it is always helpful from a budgetary standpoint to identify those and put some money away. Otherwise, you can be hit with a pretty surprising property tax bill, at least in California, every 6 months or so. Could be different in your state. But that's how to calculate your monthly mortgage payment utilizing the mortgage payment factor table. In another video, I'll go ahead and walk through the calculations on how to do this all the way through without using the table, but hopefully you found that to be helpful. Thanks for watching.